Happy Monday, everybody. Welcome to another episode and a new week of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. My name is Tony. Let's jump in. And first up, we begin in Europe. France is once again wrestling with a familiar problem: soaring debt, widening deficits, and political upheaval. Two prime ministers have fallen this year alone, trying to impose fiscal discipline, and the next one faces the same daunting task. At the center of the debate is Emmanuel Macron, the president who swept into power in 2017, vowing to modernize the French economy, only to see the country's debt-to-GDP ratio climb to one of the highest in Europe, trailing only Greece and Italy. The scale of the challenge is stark. France's budget deficit hit 5.8% in 2024. 3% is considered a red line, and this is the largest in the euro area. François Bayrou, the second premier, forced out over deficit plans this year, had tried to push through a 44 billion euro package, only for it to collapse amid political resistance. We covered this at the time. Macron's tenure has delivered some successes. Unemployment is down, France is more attractive to foreign investors, and the retirement age has been raised to 64, keeping more people in the workforce and taking some strain off the country's fiscal state of affairs. But these reforms came alongside sweeping tax cuts, reductions in corporate levies, the scrapping of a wealth tax, and the replacement of capital gains taxes with a flat levy that were never offset by spending cuts. According to the OFCE think tank, half of the increase in France's overall debt since 2017 stems from these permanent tax reductions, with pandemic and energy crisis spending accounting for the rest. Quote, Macron bears some responsibility and has made mistakes, end quote, said a former finance ministry official speaking to UK-based The Financial Times. Yet, he added, the problem is deeper. Quote, the French demand more help and protection from the state, yet also demand less tax. It's incoherent, end quote. France's public finances were further battered by an extraordinary series of crises. The protests of 2018 prompted emergency handouts. The COVID-19 pandemic required 170 billion euros in support, about 10% of GDP, and the government extended aid longer than most peers under its so-called whatever it takes mantra. Then came the energy crisis due to the war in Ukraine, during which Paris spent 72 billion euros on subsidies to shield households and businesses from soaring fuel bills. These measures blunted the shocks but left a lasting scar. As the pandemic eased, the structural shortfall in revenues caused by Macron's earlier tax cuts became clearer. Economists argue that while the crisis support was broadly justified, the permanent erosion of the tax base now leaves little room to maneuver. France has not balanced its budget since the 1970s. Public spending stood at 57% of GDP in 2023, the highest in the OECD, with nearly half devoted to pensions, health, and unemployment benefits. For decades, this model was sustained by decent growth and public acceptance of high taxes. But with productivity stagnating and deficits ballooning, the formula is no longer working. Reform now hinges on political compromise, a scarce commodity in Paris. Macron's centrists face an emboldened left, demanding wealth taxes and a rollback of pension reform. Economists such as Xavier Yavarel of the government's Council of Economic Analysis say France needs broad, sustained spending cuts across health, education, and welfare to stabilize the debt. But forging consensus will likely prove impossible before the 2027 presidential election. As Helen A. Ray, also speaking to the UK-based Financial Times of the London Business School, puts it, quote, cutting the deficit is not an economic impossibility, but it requires political will, and that is what France lacks most. End quote. But it better find that political will, because without it, France is racing towards crisis. A crisis that would make the Greek debt crisis look like a picnic in comparison. Next up, we move to North America. The dissonance in the US markets has really been sharper. Each day brings fresh signs of economic weakness and concern. Jamie Dimon and other business leaders are openly invoking the word recession. Yet Wall Street continues to scale record highs. Investor enthusiasm is not limited to equities already trading. The market for new offerings is suddenly buzzing as well. Last week, 6 initial public offerings, IPOs, raised more than $4 billion, the busiest stretch since 2021. 5 of the 6 priced above their marketed ranges. a sign of ferocious demand. But early trading was less inspiring, suggesting at least some pockets of skepticism. The muted follow-through highlights the oddity of today's cycle. Traditional caution signals coexist with a tidal wave of capital that keeps risk appetite alive. The Federal Reserve remains at the center of the story, but its influence looks diminished. In more predictable times, a whisper of tighter policy froze risk-taking, and a hint of easing unleashed a rally. Now risk markets are surging without waiting for Jerome Powell's blessing. Exchange-traded funds, ETFs, alone have absorbed more than $800 billion year to date, with $475 billion flowing into equities as mutual funds bleed. That puts a $1 trillion annual haul in sight, an unprecedented milestone. Goldman Sachs CEO David Solomon captured the mood bluntly. Quote, "It just doesn't feel to me like the policy rate is extraordinarily restrictive when you look at risk appetite." End quote. Indeed, even as labour market cracks widened, the S&P 500 climbed to another record late last week. Traders are betting heavily on 3 rate cuts this year, starting with a widely expected quarter-point reduction next week. Yet judging from the flow of money, risk-taking would continue regardless. A structural shift in investing helps explain the phenomenon. Retirement savings, 401k contributions, and model portfolios increasingly default to passive vehicles, creating what strategists call inelastic demand. With every paycheck, capital is swept into index funds and ETFs, mechanically buying risk assets on schedule. By one estimate, roughly 1% of GDP now flows into such vehicles each month, regardless of valuations or economic headlines. The numbers underscore the transformation. The US defined contribution plans hold over $12 trillion with $8.7 trillion in 401ks alone. Target date funds dominate retirement allocations, while passive vehicles now represent the majority of long-term assets. ETFs are also treated by many investors as cash-like, liquid, cheap, and easy to trade, reinforcing habits that keep flows steady through volatility, tariff shocks, or Fed hesitation. The durability of this setup will be tested if conditions sour, however. ETFs can amplify rallies, but history shows that they can magnify volatility if redemptions cluster. For now, however, markets are leaning into the narrative that easier money is coming, and that automated systemic flows will keep fueling the rally, regardless of recession chatter. If you want to be on top of the most up-to-date analysis on the biggest developments in the world's most dynamic markets, consider subscribing to Market Update. Hit the bell notification icon and you will be. And if you're getting some value from today's episode, don't forget to hit the like button. Next up, and finally for today, we move to Asia. The small Southeast Asian nation of Cambodia's economy is under mounting strain as the closure of its land border with Thailand and the return of nearly 1 million migrant workers compound existing vulnerabilities. Development institutions and analysts have slashed growth forecasts, citing trade disruptions, labour market stress, and broader external headwinds. The 5-day clash between Cambodian and Thai forces in July forced the closure of all 18 land checkpoints, halting cross-border trade. Despite a ceasefire, the crossings remain shut. Thai authorities reported a 97% plunge in border trade in July. Although Cambodian officials emphasized that sea and river routes cushioned the blow, industries reliant on Thai inputs and agricultural exports to Thailand have been hardest hit. Phnom Penh has responded by diversifying suppliers, boosting imports from Vietnam, Singapore, and Malaysia. Gasoline stations once tied to Thailand's PTT have rebranded as Peace Petroleum Cambodia, PPC. Yet the broader challenge lies in absorbing hundreds of thousands of returnees who once sustained households with Thai wages. The government says 130,000 migrants have found work at home, but more than 800,000 remain in search of stable income. International institutions have cut forecasts sharply. The IMF lowered its 2025 GDP growth estimate from 6% to 4.8%, citing weaker trade, remittances, and tourism. ASEAN Plus 3 Macroeconomic Research Office now projects 5.2% growth and warns of rising financial risks, including a 7% non-performing loan rate, which is very high. Phnom Penh-based Mekong Strategic Capital is gloomier still, forecasting just 3% growth in both 2025 and 2026, highlighting the hit to border-dependent supply chains and investment. For a nation as poor as Cambodia, that is an incredibly painful slowdown. For migrant workers like construction labourer Tang Kim Hol, speaking to Japanese financial media outlet Nikkei Asia, who returned after a decade in Thailand, the crisis is personal. Once earning $20 a day, he now struggles to find work. Now that he can no longer work in Thailand, he would be lucky to earn even half what he was earning before. Talks between the two governments last week explored reopening selected checkpoints, but without resolution, Cambodia faces a prolonged test of economic resilience. Okay, that is today's episode of Market Update. Thank you so much everybody for watching. Have a good Monday, have a productive week, and I will see you for another episode tomorrow.